I want to start today by talking about financial markets. In the first instance, there are three sorts of financial markets that we have to think about. The equities market, which is the stock market, the bond market, and the market for bank credit. I'm going to focus on the bond market and the market for bank credit because that's the theory of interest rates. And I'm going to show you how that can be linked to the classical notion of profit rate equalization, and that simplifies an enormous number of apparent problems there. And we're going to look at some empirical evidence. And then next week, I'm going to show you how the same kind of argument can explain the theory of stock prices. And we're going to look at the empirical evidence, and I'm going to end up talking about Shiller and the idea of irrational exuberance, which I'm going to argue is wrong. I'm going to argue that the reason Shiller finds that is that the theory that he's talking about, which is a standard efficient market hypothesis, is wrong. It doesn't follow, of course, that the market has no determination. He shows that the standard theory is wrong. But coming from standard theory, for him, it's pretty clear. If the standard theory is wrong, the world is irrational. And so he ends up saying markets are irrational in financial markets. It got him a Nobel Prize, so that's a pretty good argument to make these days, but I think it's wrong. I'm actually arguing for market rationality, but not that kind. The logic of the market is a different one, and I want to show you that it can be seen empirically, and we're going to end up with counterposing to Shiller's argument what might be viewed as a classical argument, closer to, by the way, to the stuff that George Soros argues in his theories reflexivity. So I'm going to end up with that. And that'll be the ending of this set of lectures, but it'll also provide the entry into exchange rates, which is a kind of mixture of real and financial movements. Okay? In the beginning, we're going concerned with the relative positions between the rates of return on bonds and equities and interest rates on bank deposits. But relative movements, which is to show how they relate to each other, has another dimension, which is how the set of them relate to real rate of return in the real sector, that is to say, goods and services sector. So we want to take the linkages, the lateral linkages, and also the vertical linkages, and show that putting them together gives you a complete theory of term structures, stock prices, bond prices, and interest rates linked to the real rate. Now, traditionally, when you approach the theory of finance, you get the horizontal linkages between financial assets, stock prices, bond prices, and sometimes bank loans. And then the question is, how do you close that link? Because that tells you one is attached to the other, but it doesn't tell you their level. It only tells you how they're related to each other. So you need an additional link to determine the overall structure. And there are several links. For instance, there's what I will call the top-down approach, which is to say, let's suppose you have an interest rate. Interest rate is linked to bond rates of return, bond prices, equity rates of return, equity prices. So that's a lateral link. But that only tells you how they're linked to each other. You still need to know their level. They can be any level and still linked to each other. And so one version is link the financial rates of return to the profit rate in the real sector. Now that's a common argument to the classical tradition, and it's also a common argument to the neoclassical tradition. In other words, the financial sector is linked to the real sector in some form. But the difference is that the two links are different. In the neoclassical argument, you say, in a risk-free world, the marginal product of capital, which is the rate of return in the real sector, is equal to the interest rate. So that's a traditional top-down neoclassical framework. I'm going to argue there's a classical equivalent of that, which is that the interest rate is linked to the profit rate in the real sector, but that doesn't mean they're equal. In fact, it necessarily means that they'll be unequal in a particular way. To do this, you need to think about the interest rate in a different way than the neoclassical one of time preference and preference between present and the future, or some such determination. Okay? And that's going to be the object of today's discussion. Then you have Keynes's approach, which might be called the bottom-up approach, which links short-term interest rates to the liquidity preference of money holders. So here, the level story is completed by linking the interest rate to subjective preferences of individuals' liquidity preferences. Neoclassical theory also has that, but it ultimately closes that link by linking it to the real sector, which Keynes does not do. If anything, Keynes ends up, as I will argue later, saying that the subjective preferences determine the interest rates, and the interest rate determines the incremental rate of return, or the rate of return on the last unit of investment, so that actually he even suggests that the real rate is determined by the subjective preferences. That's one reading of Keynes. Other people have a different reading. And I'm going to try and argue that you can, in fact, incorporate Keynes into what I'm calling the classical argument. Then there's Marx. Marx has at least two different sets of arguments. And again, the problem with Marx is always that his arguments are fragmentary because they're taken from different manuscripts written at different periods of time, not for publication, but often for working out his own ideas. And we don't know what he would have ended up with. But it's pretty clear to me from the logic of his argument that there's only one way to provide this. And I'm going to try to show you what that way is. So in one of his writings, he links the interest rate to the demand and supply for business finance. Now notice this is a similar link to the demand and supply for liquidity, for liquidity preference arguments, the supply of funds based on your liquidity preference versus the interest rate you can get from those who are demanding those funds. But here in Marx, this is internal to the circuit of capital, which is an important point. It's not based on consumer preferences, but rather on the needs of capital that can lend and needs of capital who can borrow. So already in the first step that he's making, and this is volume 3 of Capital, he talks about how capitals who don't need to invest will have funds and can lend them to capitals who do need to invest. And he says an interest rate therefore emerges from within the circuit of capital. And from here you can build on the other households and all the other stuff. But notice here the location is not subjective preference, but rather the investment preferences. So this is close to the idea of loanable funds. But loanable funds coming from capital for capital. So again, the subjective idea is taken out of the picture. And I'm going to show you that we can integrate all that stuff in. Now, the key thing to understanding a classical approach to interest rates is that to understand the idea of arbitrage. Because arbitrage is something that's done by professional investors who seek to take advantage of the differences in rates of return. And that has a tremendous implication. It is money capital flowing from one form of use to another form, whether it's a real sector or the financial sector, whether it's the bond market or the equity market or bank credit. It's money flowing around looking for profit. And it is motivated by the highest profit rate. Now that has an interesting implication, which is the one that Adam Smith mentions all along, develops all along, which is that it doesn't matter what the preference structures of individuals are. Because if your preference structure creates a higher rate of return in the stock market than it does in the bond market or in the real market, professional investors will move capital from the real market and the bond market to the equity market to take advantage of that difference. And that will override the different portfolio choices and different preference structures and subjective evaluations of the future made by heterogeneous individuals with different information. It'll create equalization of rates of return, which is independent of the decision-making of individuals. And that's the notion of the invisible hand. That's a central point of the invisible hand. That's why in classical arguments, you do not see emphasis on who thinks long and who thinks short and who has liquidity preference and who's afraid of the future, is risk averse. All of that determines individual choices. But for professional investors, they're making a judgment about rates of return and risk, which is what you see emphasized in Smith, for instance, and Marx. So with this in mind, you get the turbulent equalization of rates of return among bonds, stocks, and bonds and stocks, financial intermediaries, credit unions, banks, and so on. For reasons I'm going to develop later, it also means that financial intermediaries are subject to three kinds of arbitrage. For one thing, as keepers of funds, that is to say banks, the net interest rate they offer, net of the costs that they charge on deposits, must make them competitive with short-term bond markets, because you can move your money out of a bank into a bond market. And so there's an arbitrage between interest rates on banks and interest rates on bonds. And that's a well-known thing. It doesn't mean that you do it. It doesn't mean that you will do it. It means that there are sets of investors who prefer banks, other ones who prefer bonds, but there's that third set who look across these, and they're the ones who move money from one side to another, and they might be working for banks, or they might be working for bond market institutions, but they're looking for this interest rate differential. Okay. And then, as lenders of funds, these enterprises must be competitive with the yields on bonds and equities also. So not just as taking in deposits, which they must therefore be competing with short-term rates of return, which you can put your money in the short-term market in bonds rather than banks, but also as lenders, they know that the borrowers at the other end, businesses and longer-term investors, also can go to other markets. So there must be an arbitrage between markets. And lastly, and this is the key difference between classical and most of the other interest rate theories, which is that these are profit-making institutions. Banks are profit-making institutions. Financial institutions are profit-making institutions. And their key measure is the difference between what Hicks calls their out rate and the int rate. The out rate is what they lend at. In rate is what they take in funds. In rate on the funds is a cost plus their costs of operation. The out rate must cover a profit. And of course, profit rate equalization must mean that the out rate will be such that it gives you equal profit rates. With other activities, which could be in the commodity market, or it could be in real estate market, or it could be in the equity market, these rates of return will be equalized. Okay? So the interest rate becomes something different when you look at it that way, especially at a bank. It becomes the price of finance, the price of production of finance, if you think of it as a price which must be subject to profit rate equalization. So it'll be driven up or down and make the profit rate of banks roughly equal to the profit rate of other activities. Once you see it that way, then the rest of the way is clear. You can see how you can develop a theory of interest rates, term structure, and it doesn't matter, does not depend on subjective preference. It does depend on objective risk. That's a different story. Banks have to take into account the risk of the future. But that's not the risk of lenders and borrowers as we enter the market based on our time preference or anything of that sort. And one of the most striking things about neoclassical theory is it approaches all of these without taking into idea that they are institutions who do this lending and borrowing of money in different forms. In other words, it treats it as an operation among individuals. Now here's the implication. Suppose I start with the neoclassical idea that exchange is essentially a relationship between two objects. And that exchange is therefore also a relationship between two individuals who possess these objects. This is a standard model of exchange in neoclassical theory. Then the only thing that can determine the terms of trade of these individuals is their preference structure. Given the endowment of these two objects among individuals, individuals will bargain back and forth depending on their preference for one or the other, and you end up with a relative price which is dependent on their subjective rates of return. Right? Notice that when neoclassical theory comes to the market and introduces firms, then it's not the utility structures of the individuals, but rather the cost structures of the firm that intervenes to determine the prices. And in the classical argument, of course, these are profit-making entities selling paper and selling pens, and the price of paper and pens will be related to each other in the long run through the profitability equalization condition. Now, that overrides the subjective preferences. Once you have the profitability condition, then the cost structure becomes dominant, and the relative prices are determined by relative costs plus a normal profit on those costs. The strange thing about when interest rate theories, you realize when you're reading it, is that they never make that transition from the first step to the second step. Including Keynes. Though Keynes suggests it, he talks about carrying costs. He's still mired in the theory of subjective preferences. And that's why when he wants to attack the idea of loanable funds, he has nowhere to go but the idea of liquidity preference, which is in the end a subjective determination, because the borrowers and lenders in Keynes, as well as in neoclassical theory, are essentially individuals, not firms. And therefore there is no other determination. Is that point clear? Any questions about that? So we need to change our mindset from thinking of these operations as those among individuals and into those operations among businesses whose job it is to borrow and lend money in different forms. Before I forget, one of the key steps in this is taken by a man named Carlo Panico, who wrote a book called Theories of Interest. I think that's a title. I may not even have that right, but anyway, you can look up his name, Panico. And he has I recommend the book highly. It's a very clear and interesting statement of the rise of interest rate theories and the structure of interest rate theories in different schools of thought, including the classical economists and neoclassical theory and Keynes and post-Keynesian economics. And he makes the point that if you believe the classical argument, then you must treat interest rates the way Sraffa treats prices. That is to say, the interest rate of loans made by a bank, the characteristic example, must be treated as the price of that loan. And then the profit rate equalization condition imposes a level on that price. I'm going to follow that argument. I'm structuring it differently. And I came to it independently, but I think Panico's book is wonderful. And though my end result would be somewhat different, I think cleaner and empirically easier to see. The argument is the same, the classical argument of profit rate equalization. The first thing that you encounter when you're studying interest rates is, what do you mean by the interest rate? I mean, if you look in the newspaper, Wall Street Journal, New York Times, FT, you'll see lists of hundreds of interest rates. So what does it mean to say the interest rate? And the notion of the interest rate comes about because there's an implicit and explicit argument, depending on the school, that these interest rates are all equivalent in some sense. So you can reduce them to one. Here's the standard argument from neoclassical theory, which is called the expectation theory under certainty. Assuming that the future is known and certain, the expected rates of return on different assets are considered to be equalized by financial arbitrage. But notice there are no people who are doing this arbitrage. The arbitrage is somehow done by a market without firms. And this is called the Fisher-Keynes-Lutz theory. And it can be summarized in the following way. I is the current interest rate on some one period financial asset. Then we can define the rate of return on a longer asset, a coupon bond, for instance. A coupon bond is a bond that pays you in each period a sum of money. Say $1. It doesn't matter what the sum is because it's you buy the bond and you get a sum of money. So the rate of return on a bond is the coupon, whatever that number is. You know, your $1 a month, you clip the coupon, you collect $1. The change in the price of the assets divided by the original price of the asset. So the expected rate of return on a bond that gives you coupons for any length of time, the 1-period rate of return, is the coupon that you'll get plus the capital gains that you'll get divided by the price of that bond in that period. And that's the rate of return. Obviously, that rate of return depends on the changing prices of bonds. According to the neoclassical theory, financial arbitrage will ensure that the two 1-period rates of return are the same. It's the current interest rate on a 1-period T-bill, which is what you have given to you, and the expected rate of return on any other financial assets, such as a coupon bond, will be arbitraged because people will move between the two until the rates of return are equal. Expected now. So here's a little bit of a trick because it's not necessarily the actual rate, but the expected rate of return. Then from this kind of reasoning, you can apply it to zero coupon bonds or consols or various other bonds with intermediate life. The main point is that all bonds will be made equivalent to the current rate of return on a T-bill through arbitrage, to the expected current rate of return on bonds will be made equal. So in that sense, all financial assets in an expectational space are equivalent. Therefore, we can speak of a single rate of return, which is this rate of return on the financial asset. So this is the bottom anchor of all of those. Now, this doesn't tell us what this rate of return is. So you still need to close that loop. But it just tells us that we can get rid of, within this theory, of the spectrum by assuming that because they're all linked, we can look at just one. Okay, so when we say the interest rate, I'm going to use it in the traditional sense of the short-term rate. But I'm going to show you that you can develop another argument for the other rates. Now, it can be shown that this equalization is equivalent to saying that the price of the bond is equal to the discounted present value of the coupons. And you can sort of see that because if the current rate of return depends on this expected rate of return in the next period, you can replace the expected rate of return in the next period in terms of, and I'm sorry, this is equal to the interest rate. You can back this out and create a rate of return in the next period, which is dependent on expectations in the next period, which must be linked. And you can ultimately derive that price, the current price, in the present period of a bond, which will make these rates of return all equal to the interest rate. And that is equivalent, and can be shown to be equivalent, to saying that the bond is the discounted present value of the flows, in this case a coupon, over its lifetime. But this is an assumption, taking the current rate of return as if it's going to hold over the future. And that's a very tricky issue. There's no real rationale for that. But it works out nicely if you simply assume it to be true and back it out. So this is the foundation of the idea of an internal rate of return. It should be noted that if this statement is true, if the rate of return on a bond, expected rate of return for the next period on a bond is equal to the rate of return on a T-bill, then it follows that the yield on a bond is not equal to the interest rate. Because the yield is defined as the coupon over the current price. And the argument is specifically not that the yield is equalized to the interest rate, but that the rate of return, which includes capital gains. Now, you may choose, as an investor or risk-averse investor, you may buy a bond for its yield, because you're not planning to speculate in it. So you may choose to look at the yield. But the point that textbooks make and markets make is that that yield is your preference structure, but it's not what the market will be evaluating in terms of the bond and the short-term market. It will be evaluating the rate of return. Because even though you don't look at the rest, professional investors will. They'll be looking on including the capital gain. So that means that right from the start, we want to distinguish between the idea of a yield, which is often used in portfolio theory and subjective evaluation arguments and preference structure argument, and the rate of return, which is used typically to talk about arbitrage. And that means that each of you may have a different preference structure. You may choose short-term bond, long-term bond, depending on they're young or old, or your subjective preference for the future. That's perfectly fine. But whatever you do will create some market rate of return, and that market rate of return will attract or repel capital from this or another occupation. So if you look in the textbooks, they often say that yields are important for preferences, but they're not important for arbitrage. That's a key point. Okay, so let me define here a yield. The yield on the bond is the coupon rate over the price of the bond, the current yield. So if you go and you look in the paper, you'll see bond yields. And they're telling you if you buy this bond for $100, the current coupon is 10, the yield is 10%. But a professional, so you may choose that. You may choose that bond. You like 10%. Nowadays it would be a gold mine if you could find 10%. So you may choose it because that's fine, and you're not planning to buy and sell the bond or speculate in it. So from your point of view, it's fine. But the professional investor is looking at the profit rate, the expected rate of return on the bond, which is the yield. I'm just writing it a different way, plus the capital gains on the bond expected in the next period, right? Because you're investing now and you're taking a chance on the... So these two are different. This is where the subjective preferences enter, and this, so to speak, is where the objective capital flows enter. Though that's, again, guesses made by people, so they're still subjective in that sense. But they're measured by their success in taking advantage of that. And this is, this is such an elementary point, but it's often missed in almost all the discussions of interest rates, that it doesn't matter for the market what these elements are. They only enter into the bigger story of the arbitrage. One of the things about the neoclassical theory, expectational theory, which is this one, is that there is no, this is called the expectational arbitrage under certainty. So if you knew what the expected rate of return, expected change in the market would be, then of course there is no uncertainty attached to this, and you get the interest rate is equal to the expected rate of return, right? You then cannot have any room for liquidity premia, because this is a complete story. This is a sufficient story. You make your decision according to the rates of return, and in effect that's because the liquidity part of the story, the premia may come here. You want to lend your money according to whether you think this is a good short-term, long-term thing. But this part of the story has no room for that, because whatever determines this expectational structure, you judge it whether you get a higher rate of return or not, and you move to equalize those rates of return. Hicks points out that Keynes, when he's talking about liquidity preference, I'm going to come back to that, mentions that you have to take into account what he calls carrying costs. Now, carrying costs are really the costs of the businesses that operate in money. And once you bring in carrying costs, then you're back in the classical world. So it's possible to link Keynes's argument of liquidity preference and carrying costs, but in the end, you don't need the liquidity preference. You need the carrying costs. As long as you understand that they are not personal carrying costs, but costs of profit-making businesses. That's the key point. When you understand that, then you see suddenly you're talking about the same kind of argument that you would make with corn or steel. You're talking about the movements of capital in search of profitability. Post-Keynesian theory typically says, I'm going to come back to this point, this interest rate, short-term interest rate, is determined somehow. And nowadays, post-Keynesian theory says by the central bank. It's a very common argument in almost all post-Keynesian writers, Randy Ray and Basil Moore and Mark Lavoie and Lance Taylor sometimes make the argument that it's determined by the central bank. That's, in my opinion, that's may possibly true in some periods, but it avoids the main question. How is the interest rate determined in the absence of central bank intervention? Or are they arguing that before central banks were invented, and they're very recent in capitalism, relatively speaking, that there was no theory of the interest rates? Some people do argue that. Some people have argued that interest rates are purely conventional, and the central bank adds a convention to it. But I would argue that's essentially this notion that there is no theory of the interest rate without the central bank is really saying there's no theory of profit rate equalization. That's what they're missing in this story, and I'm going to come back to that. They do, however, some post-Keynesian economists do argue that even though the interest rate, the bottom rate is determined somehow in the central bank, the other rates are determined by banks who take in the bottom rate and then they give you money at a longer term rate, and the difference is that they create a markup on their costs. Now, as soon as you say that, you're very close to a classical idea. Because from the post-Keynesian point of view, that markup is a monopoly markup. The capitalist, the classical idea is that it's competitive markup. It reflects equal profit rates. So you come very close. I would argue that you can subsume the post-Keynesian argument within the classical one. The only difference between the two is being what determines the markup. Is it a profit rate equalization markup, which is imposed on the firm by competition? Or is it a markup dependent on monopoly power and the will of the capitalists themselves? There are other theories of interest rates, term structure, which is, say, for instance, preferred habitat theory, and you can find in almost any textbook, management textbook will have these. So with that background, which is to give you a sense of the spectrum, from my point of view, what's lurking in that background is this improperly explored issue of how competition forces a structure on interest rates. And I want to therefore start, as usual, with Smith and Ricardo and Marx. And then I'm going to move to Mill and Keynes and Kautsky and so on. Keynes, anyway. Smith, by the way, argues that the interest rate is proportional to the profit rate. And that's a very important argument, that it's proportional to the profit rate. He doesn't say why, he does it by observation, and he actually says roughly the interest rate, so you have Smith, interest rate is roughly equal to 1/2 of the profit rate. And he makes this it sounds like he's making an observation, right?
How does he make this kind of observation? I mean, he doesn't have, what kind of, hustle always how they arrive at these.
Well, they had very good data. They looked at data on profit rates, and looked at data on interest rates. And I'm sure they know from business reports. This is how Keynes does it too, by the way. Talking to people who do businesses, what's your understanding of the relation between the two? Ricardo says the same thing, again, based on his observations and readings and so on. He says the market rate of interest is regulated by some underlying natural rate. Now that's similar to the idea that the market price of a commodity is regulated by its underlying natural price. And the natural price, if you hear that term, of course suggests the price that gives you equal profit rate. So you already have a clue here. And he says the natural price, the natural interest rate is proportional to the profit rate. So you come back again to the idea that the interest rate is linked to the profit rate in some sense. So that means that in some sense, this natural interest rate moves with the profit rate. He provides no derivation for this. But he subsequently qualifies his statement to say, there are considerable intervals during which a low rate of interest is compatible with a high profit rate. Thus, the proposition that the rate of interest is proportional to the profit rate, he says, quote unquote, cannot be admitted without great qualifications. So he says two things. He says this is somehow a long run, natural interest rate is linked to the profit rate, but the market rate can be above or below it for longer or shorter periods, so that we can't take the market rate to be the natural rate. But this is a clue. In my opinion, it's always good to take clues from geniuses because it gives you some help as you're moving along. And so here you get a link, market rate to natural rate to the profit rate, but we don't know what that latter rate is. And so that's Mill and Took pick up on this issue. Mill says that the interest rate can vary permanently or temporarily at any given profit rate. So now Mill is saying the market rate can vary independent of the profit rate. So sometimes they both treat the interest rate as independent. They can see the profit rate and the interest rate are not directly linked. But at the other hand, they say that they talk about banks. And they say, well, interest rates, banks are involved in interest rates, and banks are concerned with the profit rate. So now you have another clue. The interest rate is different from the profit rate. On the other hand, banks are interest rate setters, so to speak, and they're concerned with the profit rate. So that suggests that the bank interest rate is related to the profit rate, not in the direct sense, but that it must be related, it must be a level that gives the bank a normal profit rate. And that's not the same thing saying it's proportional to the profit rate, we think. They talk about the additional issue of banknotes, the creation of money will affect the interest rate and the price level, but then they say the effect on the interest rate is only temporary, so it'll come back to some other level. Took says that bankers are middlemen who have no power at all to affect the average rate of interest. So now the banks are taking in interest, taking in deposit at some rate, and they're giving it out another rate, and all they do is keep the difference. But of course, then the question is, why do they have no power? Then their profit rate is completely arbitrary. They're middlemen, but middlemen are all producers. They take in raw materials and sell things in another product, and Smith and Mill and Ricardo don't say they have no influence. They say competition determines them, not what they decide, but what competition forces them. Both say that government borrowing can permanently change the interest rate independently of the profit rate. So that's very suggestive of the post-Keynesian argument, that the state can determine the interest rate independent of the profit rate. Yet, at the same time, Mill says banks, after all, are businesses. They're profit-making businesses. So the interest rate cannot be sort of independent of bank profitability or vice versa. So therefore, banks participate in the equalization of profit rates. And right away, that's a big clue. Because if banks participate in the equalization of profit rates, then the interest rate cannot be independent of profit rate equalization. So that's the first part, this mixture of links between the interest rate and the profit rate, and the suggestion that those who provide the interest rate are profit-making enterprises, so therefore they must provide it at a price which makes it possible for them to make profit, and indeed a price which will be forced by competition to reflect a normal profit rate. So that's one dimension. The other dimension is the following. In his History of Prices, Took's History of Prices, which is an amazing book, should be read, he observes that the interest rate and the price level tend to move together. And that observation was subsequently rediscovered by Gibson, and it's called Gibson's paradox, because orthodox economics says that that shouldn't happen. It has a different hypothesis, which I'm going to come to, which is called Fisher's hypothesis on interest rate. So Took had already discovered this. And that discovery, this is essentially Took's finding, only Took wasn't here in 2007, but anyway, the basic idea is that this is a producer price index, and this is the interest rate. And until you get the big sort of interventions in the interest rate that start taking place in the neoliberal era, in the late 70s, early 80s, you can see that there is a real long-term co-movement in these rates. They're not identical, but they drift upward and downward together. And this observation that the level of the interest rate is linked to the level of the price, to the price level, was later called Gibson's paradox. And Keynes comments on this and says this is one of the best established propositions in economics, that the level of the interest rate is linked to the price level. in the absence, of course, of state intervention and so on. Tuck tries to explain this. Tuck says, and remember, Tuck is operating in this, he has data going back earlier, by the way, but let's say he's operating, where is he operating? Somewhere in this part earlier. He tries to explain it by saying that interest rates rise with prices because prices depend on costs and interest rates are costs. So he tries to show that the correlation between the two comes from interest rates to prices. Marx points out that it's not true that you can count what you loan, what you borrow as part of your cost. That determines your splitting up of your profits, but you can't say to people, my goods are more costly because I borrowed a lot of money. That's your problem. The cost is the cost of production. So the classical idea of the price of production and market price is based on the actual costs, operating costs, not whether you choose to borrow a lot or not borrow a lot. That decides whether your profit is divided between interest and what's left over for you. So that's a separate issue. Now this brings me, and any questions up to here? So we have already in front of us an important phenomena to be explained, which is a relationship between interest rates and profit rates in the absence of deliberate intervention to suppress or target interest rates. So we come to Marx. And when Marx enters into this debate, three things are already established. Three arguments. Interest rates appear to move independently of the profit rate, at least in the medium and short run. And Ricardo makes this concession. Smith says it someplace. Mill talks about it. So the idea that the interest rate is proportional to the profit rate doesn't make any sense, at least to Marx. On the other hand, interest rates are correlated with the price level. But the third part of the argument, which is implicit in Marx and in some places explicit, and implicit in Mill and some places explicit, is that financial firms participate in profit rate equalization. Capital goes to wherever profits are made, and if profits are higher in one place, they go there, whether they're financial firms or real firms. So now you have a problem. You have a theoretical, logical implication from the theory, which is that all firms, all areas of applications of capital will generally be subject to profit rate equalization. And yet, at the same time, Marx wants to argue that the profit rate is not linked to the interest rate is not linked to the profit rate. And one reason he does that is that he knows what Tuck has found. In fact, Marx comments on Tuck and says, look, the interest rate moves with the price level. Well, the profit rate doesn't move with the price level. There's no reason to link the real profit rate with the price level. So obviously you have a problem if you say the interest rate is linked to the profit rate and the profit rate doesn't move with the price level, then the interest rate is not one-to-one with the profit rate. Or to put it another way, Marx concludes, therefore, that there is no such thing as a natural rate of interest that Ricardo is talking about that regulates the market rate, because that natural rate wouldn't move with the price level. And by the natural rate, he says, people mean the rate fixed by free competition. There are no natural rate limits to the rate of interest, and that's Marx, Volume 3, Part 5, Chapter 21. So here he seems to decisively reject the idea that there is any underlying natural rate of interest. In fact, he says the only limits to the interest rate are that the interest rate must be positive, otherwise capitalists will not lend any money, and it must be less than the profit rate because otherwise capitalists will not borrow any money. And so if you think of it as an operation within capital, it must be between 0 and the profit rate. He also says the quantity of money can affect the level of the interest rate, And since the interest rate determines the difference between the profit rate and the interest rate, which he calls profit of enterprise, which is a motivation for investment, money can determine real movements. In other words, there is no separation then between the real sector and the monetary sector, because monetary factors can influence the real rate of the net rate of return in the real sector, and therefore influence accumulation. So that's very Keynesian sounding, that there is not a separation between the two. Yeah. Yeah. Marx points out that the quantity of money, an increase in the quantity of money can affect the interest rate. I mean, that's a well-known observation. When money flows in and out of a country or gold mines are discovered, the increase in the quantity of money, and Marx specifically argues, increases liquidity. Increasing liquidity means it drives the interest rate down. But the interest rate is the benchmark for investment, because the profit rate on investment minus the interest rate determines your net rate of return. So if the interest rate is reduced, investment is stimulated. That's very, very similar to Keynes's subsequent argument that the interest rate depends on expected rate of return on profit minus the interest rate, or the marginal efficiency of capital minus the interest rate. And so Marx is specifically arguing against the idea that monetary factors have no influence on the real. But then Marx argues elsewhere that the banking sector is subject to profit rate equalization, such as any other profit-making institution. I mean, bank capital is no different than any other capital. It's just a particular application. And he goes on to say that the bank profit rate depends on the difference between the in rate, the rate that they pay on deposits, and the out rate, which is the rate they charge for loans. So now he's telling us, okay, the in rate minus the out rate minus the in rate and costs has to be related to the normal profit rate, which means at least the out rate is linked to the profit rate. The question is whether the in rate is linked to the profit rate. And he says the bank rate of profit is equalized, so that we know that the out rate is therefore a price of production. That we can already tell from that argument. But he never gets around to explaining how the interest rates on the in side, the deposit rate, is determined. And we don't know whether he could have worked it out, whether he did work it out. All of this discussion is in Volume 3 of Capital, which Marx never published and did not intend for publication in the form which he left it. It was drafts and notes. So you always have this problem. I'm going to come back to that. Obviously, I'm giving strong clues that I'm coming back to that. How about neoclassical theory? As I said, neoclassical theory says that the interest rate on short-term deposits is, in a world of certainty, linked to expected rate of returns on bonds and equities and all sorts of financial assets. So all of those are linked together, and their prices will then be determined by that linkage. So that leaves the interest rate on short-term deposits. How do we explain it? And the neoclassical argument is, in the long run, it's equal to the marginal product of capital. But we know the marginal product of capital in the long run is determined by the full employment of labor. In the standard neoclassical model, the wage moves to make labor fully employed. It makes the demand and supply for labor equal at a particular real wage, and that real wage means that the marginal product of labor is determined to make full employment, which means the marginal product of capital is that which is consistent with full employment. In other words, it's the full employment marginal product of capital. And interest rate arbitrage among riskless assets makes the interest rate, monetary interest rate, or real interest rate equal to the marginal product of capital at a full employment level. So now the circle is closed. You go from the labor market, full employment, to the marginal product of capital consistent with that full employment condition, to the real interest rate, which, if price levels are not changing, is the nominal interest rate in magnitude. Okay? Now we come to Keynes. Keynes is obviously trying to break the neoclassical argument that the profit rate that the wage moves to give you full employment labor, but he also has to break the other side of the argument that the interest rate moves automatically to give you demand equal to full employment supply. And so he needs to break the interest rate. He needs to attack that too. And what he does is try to replace the argument that the interest rate makes demand and supply in the loanable funds market equal, which would make aggregate demand equal to aggregate supply, because the difference between aggregate demand and aggregate supply is consumption plus investment minus consumption plus savings. So it's investment minus savings, consumption's on both sides. And so excess demand is investment minus savings. But if the interest rate makes investment equal to savings in the loanable fund market, then the interest rate makes aggregate demand equal to full employment supply. So Keynes has to attack that, and he substitutes a theory of liquidity preference. He says liquidity preference of money holders sets the floor to the interest rate, and the expectations of these determine interest rates, future interest rates, and judgments of risks, and so on. The bottom interest rate, the one that links all of this, is determined by convention and historical factors, so that the bottom is not linked to the marginal product of capital. In fact, at one moment, Keynes even suggests that the profit rate on capital is linked to the interest rate, because the last investment put in will have a rate of return equal to the interest rate. So the functioning rate of return, marginal efficiency of capital, is equal to the interest rate, which is now running the whole show. Sraffa picks up on this in an incidental remark also, where he says, well, the interest rate could be determining the profit rate, though he backs off from it again, but you can see the influence of Keynes there, or maybe the influence of Sraffa on Keynes. It's never clear. Keynes used to call Sraffa the one who knows all or sees all. Like I think it sees all, I think he says about Sraffa. As for the term structure, in Keynes, it's a mixture of carrying costs, liquidity premia for short and long-term loans. And so I would argue, if you read Keynes' theory of interest rates and you read the literature on it, most people agree that it is very suggestive and stimulating, but extremely muddled. It's mixed up because it has many things, and it's not clear how Keynes would have proceeded had he lived to do a second edition of the general theory, because many of the comments and criticisms that came in might have been incorporated and might have gone a different way. And then the last point, which I mentioned before, is that post-Keynesian theory talks about that missing interest rate, the bottom rate, the short-term interest rate, is being determined by the state through open market operations or a variety of different, and nowadays even through operations going all the way up. And the other levels of the interest rate, longer rates of return, are then determined by the cost. So you can think of the post-Keynesian argument. The in rate is determined by the state. Banks have to pay that on deposits. Then they charge an out rate on loans, short-term and longer-term loans, which depend on their costs plus a markup. That markup reflects monopoly power or oligopoly power. That's very, very close to the classical argument I want to make, which is that the in rate plus costs plus a normal profit rate determines the out rate, except that I don't want to leave that in rate dangling in space. So I'm going to focus in the first instance on the in rate. Before that, one last point, which is Wicksel's argument. I mentioned that this argument by Tooke, or this finding by Tooke, which is later called Gibson's paradox. Why is it called a paradox? It should be called Gibson's finding, and it should be called actually Tooke's finding, not Gibson's finding. Tooke's law, because it's a very powerful empirical proposition. As Keynes says, it's the best known empirical phenomena in economics. What am I doing? Down, command page down. And the reason it's called a paradox is that in neoclassical theory, the rate which is linked, the link between the interest rate and the profit rate, is that the real interest rate is equal to the full employment profit rate. Now, if there's no price change, it's the nominal interest rate is equal to the profit rate. But in general, the real interest rate is defined in Fisher and by Wicksell in neoclassical economics as the interest rate minus the rate of change of prices. It follows that the interest rate will be equal to the profit rate plus the rate of change of prices. And the profit rate is not the observed rate, it's the marginal product of capital. It's some kind of time preference and often taken as constant. So the interest rate, another way to put it, is the real interest rate will be constant. That's one way of looking at the standard hypothesis. The other one is, of course, that the nominal interest rate is linked to a constant plus the rate of change of prices and not the level of prices. So here you have Tooke's finding, which is that the level of the interest rate is linked to the level of prices. And you have the neoclassical expectation that the level of the interest rate should be linked to the rate of change of prices. Now, this is one of the best known falsified economic propositions. It's just not true. And people come up with more and more complicated explanations for why it's not true. But a simple alternative is to find out why the empirical fact is true. And that is not to come here, but to come back to the issue of the link between the interest rate and the profit rate, which is what I want to do next. Any questions so far? So this is to set up the issue, which is that we want to explain the base rate first, and we want to do it without relying on the invention of the central bank, which is late in economic history, not relying on subjective preferences, but relying on the same old principle throughout that I've been using throughout the course and is fundamental to classical economics, which is the mobility of capital in search of profit. The principle that is central to Smith, Ricardo, Marx, Mill, Tooke, and others. The key to the classical argument is always to focus on structural determination, not subjective and psychological determination. Production requires time, and therefore it entails costs and risks. And if you didn't take that into account, you would have no explanation for market price except demand and supply and subjective preferences of sellers and buyers. Once you bring that in, then you have an objective determination based on costs and profits. In the same sense, banks exist because there are intrinsic costs and risks involved in borrowing and lending money. The job, I'm calling them banks, but it's financial institutions. The job of these institutions is to make money by using money, by selling money or buying money. Banking, of course, has its origin in goldsmiths, so it goes back very far. They were used to store money, but then they discovered quickly that they could lend out the money that they were storing, and they could make money by lending out the money as long as people didn't ask for their money back in an amount greater than what they had stored. So that went from 100% reserve systems to fractional reserve just from the logic of competition and logic of profitability. If you had a lot of money sitting around and people were paying you to keep it safe, well, then you could lend some of it out, and as long as not everybody came back and asked you for the money at the same time, as long as you kept a reserve, you can make money on the money that was not being used. And that's where banking comes about. That's a source of fractional reserve banking. The problem with neoclassical theory is that it typically abstracts from the structural determination, abstracts from time, costs, and risk, and that leaves only subjective determination. I want to emphasize the other side of the argument, which is that if you look at competition in the banking sector and you look at banks, I'm going to call them banks, I mean financial entities as a whole, then you get a very simple, clear, and detailed description of interest rate structures, which you can look at empirically, you can test. So let's start with the simplest case. Banks who take in demand deposits and don't pay any interest because they're performing the function of the goldsmith. They are, in fact, charging you money typically on demand deposits because they are performing the service of safeguarding them. It's better than having them under your mattress or buried in your yard, assuming you had a yard. That was in the olden days, but still you have a mattress. The banks are an alternative for safekeeping. And they're safer than cash, and they are more convenient once they get established because you can exchange bank deposits among people without having to carry the cash around. So we know all of those. So banks compete by offering these banking conveniences in order to attract and retain depositors. And this is a point that Hicks makes in his theory of money, the market theory of money. Basil Moore makes it in his book, Horizontalists and Verticalists. So at the in level, banks are taking in deposits in return for which they offer you safety. And they can then make loans, short-term loans, from these deposits. And as soon as you say that, since you know that demand deposits are withdrawn easily, banks that are taking in demand deposits to make loans can only make short-term loans. So the first step is to recognize the short-term loan bank or the short-term loan division of a bank. It makes no difference. Let's call it a short-term loan bank. I'll pick up long-term loans in a minute. If different banks are taking in deposits, competing with each other, and they're using it to make short-term loans, then clearly arbitrage among banks will make the loan rates equal. So the short-term loan rate will be equalized by competition. Is that point clear? It's just like saying you're all selling apples, but the price of apples will be equalized by arbitrage roughly. So the price of apples will be roughly equalized. That doesn't tell you the profit rate on apple selling, but it tells you have to have a common price. So that's the first moment of competition already, the equalization of the price of the loan, which is the short-term interest rate. And that's where you get the first condition for the interest rate. The first condition is this one, that the interest rate will have to be positive. Otherwise, the banks don't make any money. But they'll be less than the profit rate. Otherwise, businesses will not borrow from the banks, will not borrow short-term from the banks. But now we come to the fact that the interest rate charged by a bank on short-term loans is the price of the loan. So its sales are the interest rate times the amount of loans, right? How do we determine its profits? We take the interest rate times the amount of short-term loans, and we subtract from that the costs of loans, the costs of deposits, the cost of loans times the amount of loans, the cost of deposit times the amount of deposits, plus the, and that gives us a profit. How do we measure the profit rate? We have to divide that profit by the capital. And the capital is the capital invested in lending and borrowing, and the capital in reserves. For banks, that's a very important aspect of their capital, is their reserves that they have to hold to make this operation safe. So now we have a measure of the profit rate of banks. It's the revenue from loans minus the costs of loans, that's the profit, divided by the capital stock involved in borrowing and lending. Banks are obviously have to have some prudent relationship between reserves and deposits, because every deposit, and between reserves and loans, because loans create deposits and deposits create the possibility of taking out money. They don't necessarily have to stay in your bank, so you have to have reserves related to deposits. So we can define some variables. Let reserves equal the reserve deposit ratio times the amount of deposits. In other words, the the prudent reserves are a prudent reserve deposit ratio, a kind of measure of the safety of the bank's operation, times the amount of deposits. And typically, the state intervenes at some stage in capitalist history, principally because it's the interest of firms to go below this limit if they can get away with the banks to go, and then find out in practice that they don't have your money when you go looking for it. If we abstract from the bank costs, for the moment, the costs of borrowing, the costs of taking in deposits, and the costs of making loans, then the sales of the banks are their profits. So the profit of the bank is simply its interest rate times the amount of loans, because there are no costs at this level of abstraction. And the capital of the bank is its reserves. If we divide through by the loan, then we can say that the capital of the bank is its prudent reserve to deposit ratio times the deposit to loan ratio. And both of these are ratios that banks have to pay attention to because they cannot overextend. So in some sense, they are structurally necessary ratios. Of course, individual banks will go below that and may go bankrupt. Other banks may stay up safe and not make as much profit, but the market sort of enforces some normal levels of these numbers. Everybody with me here? So if you're running a bank, and I say to you, what's your profit rate? And you say, well, I just made $10,000 from loans. Okay, that's your sales. And your costs you ignore. Let's say we ignore for the moment. I don't have any costs, so that's sales of my profit. What does it cost you? Well, the capital on which I have all this done, I'm ignoring the fixed capital and the computers and all that. The principal capital of a bank is its reserves. So if you abstract from its fixed capital and its carrying costs, the bank profit rate boils down to the interest rate divided by the structural parameters, its reserve to deposit ratio and its deposit to loan ratio. Now, let's consider what happens then if you take this level of abstraction, which I'm deliberately abstracting from abstracting from costs and capital in the bank, and let's say that the bank profit rate is equalized with the general profit rate. If that's the case, then this relationship becomes inverted because the bank rate is now the market rate, but if the market rate is equalized to the normal rate in the other markets, in the general rate of profit, then you can see that determines the normal interest rate. The equilibrium, the competitive equilibrium interest rate is dependent on the reserve to deposit ratio, the deposit to loan ratio, both of which banks have to pay attention to their structural relations from their safety point of view, and the profit rate. And if these ratios are roughly stable, then the interest rate is proportional to the profit rate, which is exactly what Smith was arguing. Now, this is a long-term rate, and it follows directly from profit rate equalization under the condition that you assume away costs. And I want to come back to that. It's a very important condition. But I want to show you that the most abstract level, profit rate equalization, gets you exactly what Smith and Ricardo understood, and I'm positive that they understood it pretty much in this way, even though they didn't formalize it. Okay? I see skepticism and puzzlement in the air. So questions, comments? All I've done is define the profit rate of a bank and say it's equal to the general rate of profit. But that implies that the interest rate is a price of production. That's what I'm saying here, right? So that gives us a normal or a natural rate of interest. And this is exactly what Marx is opposed to, because this doesn't depend in any way on the price level. And Marx says, well, look, Tuck has already shown that this is not true. The interest rate does depend on the price level. And therefore, the kind of argument that the interest rate is proportional to the price level in the long run can't be true. I want to show you that the argument that I've just been making gives you exactly that empirical result when you make it more concrete. I've tried throughout, whenever I present things about pricing and all that, to introduce the idea that what is true at one level of abstraction has to be built up to the more concrete level to incorporate other things. You remember when we were talking about prices, I said, suppose all prices are equal. Then firms with different costs will have different profit margins. But then we say, let's suppose that the fact is that competition introduces new firms with lower costs. It forces a price cut. If the price cuts are not all equal, then there will be a distribution of prices. And they'll be correlated with costs because the weaker capitals will not be able to afford to match the cost. And then suddenly you find that prices are under pressure, but that doesn't imply they're equal, and you get all of Kalecki's results right there from competition. So that's why it's important to be concrete. Just as if you drop balls and a feather in a vacuum, they fall at the same rate. But you drop balls and a feather when the tube is filled with gas, the feather drops much more slowly. That's not a contradiction to the law of gravity. That's a concretization of the law of gravity. So I want to show you that this law of gravity in economics, which is arbitrage and profit rate equalization, immediately leads to another result. So here, all I'm doing now is doing what I did before, which is say that the interest rate must reflect costs plus a normal rate of profit. And that normal rate of profit on reserves is this part. But there are other elements. There's real costs on loans, real costs on deposits times the ratio of deposits to loans. Because the interest rate is the interest rate per loan. So all the costs have to be related to loans, right? So the costs, real costs of loans, the real cost of deposits times the amount of deposits per loan, that was calling D over L before. The profit rate times the fixed capital in a bank. A bank has buildings and machinery and paper and pencils and computers and all of that. So that has to be part of your inventory of fixed capital. So this term here, which was what we had before, is now supplemented by all these real costs times the price level, because the nominal interest rate is a price. And the costs have to be expressed in the same terms as the price. They have to be nominal costs. They can be costs relative to some commodity that numeraire, it doesn't matter, but it's a price level. And now you see something immediate. This is the profit rate, which is determined by the profit rate equalization condition of a firm when you take costs into account. And that implies that as a price level goes up, for any level of costs and profit rate, the interest rate will follow. In other words, you get Gibson's law, or Tuck's law, from simply the expression of profit rate equalization. I would argue that even the earlier result was a remarkable one, the simpler result, which is that the interest rate is determined just by the profit rate and the bank structure. But now we see that the interest rate is determined by the profit rate, bank structure, which includes costs, and the price level. And it is kind of interesting to consider whether Marx would have gotten to this point or not. I'm sure, you know, when people go through more of the manuscripts, there'll be this argument will already be there in Marx. But I haven't found it in the Marxist literature. The only person who comes close is Panico. He doesn't do it this way. And in the end, unfortunately, his argument doesn't work. It's clear it doesn't work. And even he seems clear at it. He puts it together in the end. But he sets up the question, which is the most important issue, which is what is the interest rate determined by profit rate equalization? And you can see that this is really a Sraffa interest rate. with the specificity of banks. Because this part here is your costs plus the rate of profit times the money value of capital, so it's P times that, plus some rate of profit times the money value of reserves. And that's Rafa's profit rate, the profit rate equalization equation. And Sraffa's, of course, building on the classical notion of profit rate equalization, which he formalizes, but he does not invent. Marx actually, in different parts, seems to come pretty close to this argument, but he doesn't quite seem to, because they're different parts. In Theories of Surplus Value, he has comments on the relative level of the interest rate and the profit rate, and comments on Mill. I'm going to skip that in the interest of time. What is important is that if this interest rate is going to be viable, the ratio of deposits to loans and costs must be such that the interest rate is less than the profit rate. Because banks are taking in deposit. This is the bank of the first level, the bank on the first floor, so to speak, where you go into the teller, you put your deposits in, and then, as one textbook says, the teller walks across and lends the money to someone else who's borrowing short term. And so this is the short-term interest rate that we're talking about, the base rate. And it's determined by competition. Now, once you say the base rate is determined by competition, then it's easy to build up a story of the term structure of rates. Let me go back for a moment to the bank rate itself. From the point of view of a bank, a rise in prices is bad because it raises its costs. And at a given interest rate, it's going to squeeze its profit. On the other hand, competition will force the interest rate to adapt to that by coming up or down according to the supply of capital into the banking sector, which will, if the bank sector's profit goes down, the supply of capital in the banking sector goes down, the interest rates will rise, so the interest rate will come back to giving you a roughly normal profit rate. It'll look like banks are increasing the interest rate to maintain their profit rate, but that's what competition is doing, not banks. It's the surviving banks. The other ones don't survive. So this is not the decision of the bank, it's so to speak, the outcome of competitions. Now we can come to, and I think I have time to do this, to the theory of the term structure. The idea of the term structure is the following. Why is it that, generally speaking, but not always, interest rates which are longer term, loans which are longer term have a higher interest rate than loans that are shorter term? And one answer is, well, people have a subjective preference for the present versus the future, and therefore they're not willing to lend you money for longer term unless you give them more money. That's the expectational or subjective preference approach to term structure. But as I pointed out in the neoclassical theory, you cannot derive a term structure from that because profit rate equalization will make all expectations give you the same rate of return. And that's a big problem for standard theory, how to derive a term structure from that. Liquidity preference, you can derive a term structure. People don't want to lend you money longer term. But in the classical argument, you can't do that because profit rate equalization doesn't depend on your preferences. It overrides them. And so then the question becomes, what is it about the structure of banking that would make it so? And the obvious answer is, imagine that we now have a second division of banks. The first division takes in deposits and it makes loans. The second division can price its input as the short-term loan, and it makes a two-period deposit. So in effect, what it's doing is comparing, it's operating on it's borrowing money in the short run, but not as short as deposits, in order to lend money a little bit longer. Now, banks have to link the time dependency of the in and out. A longer term has to have a longer term base than deposits. It has to base itself on having money for some period of time. So effectively what banks are doing is taking in interest rates that are taking in money which is available for some period of time, which is a short-term loan, and lending out ever longer. So the second division in effect is the in rate is the short-term interest rate times the amount of loans, and the out rate is the longer-term interest rate. Now, why would the longer-term rate be greater? Because, in fact, a longer-term commitment of fund requires larger deposits, larger reserves, larger deposit-to-loan ratios, higher risk because of the uncertainty, objective uncertainty associated with the future. And so the costs are greater. And typically, the longer term, longer the loan, the higher the risks and the higher the costs. So you have a two-period loan with two-period costs, and the one-period loan is the input. The one-period short-term funds are the input, and the two-period loan is the output. Again, profit rate equalization will impose a two-period rate of interest, which will give you a normal profit rate. And that will be higher because it's based on the one period plus costs. So you get a higher rate of interest, and you can then build up a term structure. And that's only true for the unobserved equalized profit rate. So we're going to ask next time, I'm going to ask you the question, all of this depends on the idea that bank profit rates are equalized. So the first thing we want to look at is it true? Because if that's true, then I can explain all of this stuff just straightforward from equalization of profit rates. And obviously, if you can do it for two-term loans, you can think of three-term loans as 2 terms in and 3 terms out, just built up. And so you can build up a whole structure of the interest rate. This is, in fact, the argument made by Hicks in his Market Theory of Money. He points out that you can view every loan as taking in a shorter term in and putting a longer term out. The only difference is that Hicks doesn't provide any explanation of the base rate. Everything else he provides an explanation. So what I'm talking about, the base rate fills the gap in Hicks, and you don't have to do it through liquidity preference or subjective structure. And the rest of the Hicks structure, it provides immediately then a yield curve. A yield curve. And you can see then this is very similar to the post-Keynesian argument. They have an in rate short term, which they fix by the state, but the rest is costs of loans with markups on the costs, and then you get the yield curve from that. But again, this is determined by competition in my case, whereas in their case it's determined by monopoly or fixed markups. And one of the things I want to look at next time is it true that markups are fixed? We have data on this. We have interest rates by all length. If the argument that I'm talking about is true, the interest rates will move together because they're structurally connected in normal times. But of course, that's only if the interest rates are reflecting long-term factors. In the short run, the yield curve can invert or move away because short-term factors can be important. And obviously, the state can also intervene to affect short-term or medium-term, the QE kind of arguments, QE operations, which can affect medium-term interest rates by state intervention. So to summarize the argument so far, the classical theory of interest rates has 3 main results. In the short term, interest rates of various terms will be determined by the demand and supplies for various loans and deposits, because these are market rates. So that depends on preferences and events and movements of all sorts and portfolio and foreign trade and all of those factors. And they will vary according to cyclical and conjunctural factors. So we'd expect a lot of short-term movement. Hence, in the short run, the yield curve, which is the length of loan on the horizontal axis and the interest rate on the vertical axis, will not necessarily be upward sloping. It could reverse, and it can have a variety of shapes. However, over the medium run, the equalization of profit rates among different banking operations will put into place a normal yield curve, and that will be upward sloping because of the structure, costs, and risks attached to longer term loans rather than shorter term loans. In that case, the whole structure of interest rates will be determined fundamentally by the profit rate, the general rate of profit. And, of course, banking structures. I want to make one more point, which is that if you think of this as the price, the nominal price of money, then I could think of the interest rate over the price level as a kind of real price of production. The interest rate is the nominal price of production, right? So I could divide the interest rate by the price level, and I'll be looking at something very close to a relative price of money. And it's quite interesting that I've never seen any calculations or pictures of the interest rate relative to the price level in the long run. In this case, we saw the interest rate compared to the price level. I forgot a graph, which is why there's one I skipped over here and maybe just mentioned it. I'll mention it now. This is the interest rate moving along with the price level. But now I'm posing a different question. What is the ratio of the interest rate to the price level? What is the real price of production of finance? And you'll see some startling patterns that way, a really startling pattern. But you can see it'll ultimately depend on the real cost of finance compared to the real cost of commodities. So it's a measure of the cost side of the story. Now the picture I forgot, I skipped over this in my notes. I talked about the Wicksell argument that the interest rate has to be linked to the inflation rate. Or another way to put it is that the real interest rate has to be equal to this real rate of return, which is a sort of fundamental preference structure, time preference structure rate, which is fixed over time. So we'd expect the real interest rate to be constant. And this is a picture of the actual real interest rate. This is the real interest rate and its HP filtered value from 1857 to 2011. And what you can see is that the real interest rate moves enormously. And even if you smooth it, you're talking about movements from 0 to 12% and down to 0 or negative, and 8% and down to negative 3% and up to 5% and so on. There's no sense in which the real interest rate is stable over time. And yet that is the proposition that orthodox theory gives you, and that's why orthodox theory expects the interest rate to be related to inflation. This is showing that it is not, in fact. It is related to the price level. Okay? So this is why the finding by Tooke and Gibson is called Gibson's paradox, because it contradicts the orthodox expectation. But of course the data contradicts the orthodox expectation. That's the key point. Now we can explain all of that. We can explain interest rate relation to profit rates. We can show interest rate relation to the price level. We can show the interest rate term structure without deriving it in any way from subjective preferences or any other such variables in the long run, though they might be important in the short run. Next time I'm going to pick up the stock market and extension of this argument to the equalization of rates of return, stocks, bonds, and all of that stuff about rational, irrational exuberance. Yes?
I think that there is a difference between banks and companies in reality. Because usually the banks, they never bankrupt. For example, in Greece, it's so if you say that we have competition among banks, they will already be closed, all these banks. And the government try to give the money all the time. What happened in this case?
Well, why did they try to give the money? Because they were going bankrupt. I mean, to say that competition makes you bankrupt doesn't mean that if your rich relative comes in and gives you money, you'll be bankrupt. It just means that competition made you bankrupt and somebody covered your losses, right? So what the state has been doing everywhere is preventing competition from having that consequence. But it did that because the alternative was massive bankruptcies. So I would argue just the opposite. Banks weren't completely bankrupt. Their bankruptcies being covered up by the printing of money. And that's a very important thing, but that's like telling me that the law of gravity works, but I need to push hard if I don't want this building to fall on top of me, right? And that's a difference. I would argue it was exactly the opposite. The whole financial crisis was an expression of competition. With a bubble built up, it was unsustainable, and some banks, by the way, did go bankrupt. Some countries, and maybe not in Greece, but in Ireland, in Iceland and other countries, they did go bankrupt. In the United States, some companies went bankrupt. Some banks went bankrupt. You can look at a picture of bank failures. By the way, this time is not so bad, but look in 1987, where there was another big crisis, a bubble that burst, and you can see the bankruptcy rate and business failure rate up and down. You spike up and down. So I would argue it works extremely well. It doesn't mean that we can say that the state is not an actor. I'm building this up deliberately abstracting from the state because I want to show the force field that the state has to go against. The state wouldn't have to intervene if competition didn't make banks bankrupt. Well, the problem is I'm now referring from the book, and the problem is it's hard to take those lectures in one lecture time, just too much. People don't have the background. So I'm splitting up each lecture into two parts. The syllabus is general reading, but the book is really where all of this is put together. None of this is in the syllabus. It's a background. Although if you want to look at one thing in the syllabus, look at Panico. Panico's book, Theories of Interest, because it's a wonderful book and it covers all the material that I've talked about today without accepted conclusion of how to put it all together. Okay? Yeah. Okay. So, yes.
More things. There is one thing or two things that I can make sense of. One is how can we close the price system when I also depends on the price level?
You mean in a Serafian system? Okay, very good question. Okay, so let's go back to that. That's fairly easy. What you're doing in a Serafian system is adding this equation. One equation and one more variable, right? Then the system is closed. And in fact, the P part is determined independently of this because interest rates don't enter into costs in the classical argument. Costs are your sharing of profit between interest and profit of enterprise, as Marx puts it. It's how much you have to hand over to your borrower, to your lenders. But so this adds a completely independent equation. And I can add as many of these as I have length of loans. So I add a subset. And I think that's a mix-up that Panico gets all confused about interest as cost and not, and adds liquidity premia and all of that because he's trying to figure out how to close it. But this is a simple natural closure, and it immediately makes a Serafian system appends to it without changing the structure of the prices at all. So a good question.
And the second one was, depends on people who lend money and people who take that money. But if the rate of profit is high, then people will want to borrow more money.
Not people. I never use the word people. Firms.
Yeah,
Firm, because there's a difference. Individual people may want to, but the firms are the arbitrageurs.
Yes.
So
I mean, I don't get how the rate of interest can be like in a different circle from the rate of profit when borrowing depends on how big profits are.
okay. Okay, so suppose that we have a bank here, and this banking sector has a very high rate of interest, right? And you guys have a low rate of interest. So your money coming in is going to be diverted to this bank. The supply of this type of loan, let's say whatever length of loan it is going to expand. More and more people are going to compete to try to offer this loan. That brings the interest rate down. It brings it down into the general pool, because there are profits to be made here. It's the same way as if this was a high price of corn, high relative to a normal profit rate, high profit rate of corn. The supply expands when the profit rate is above normal, and it contracts relatively when it's below normal. And that brings these two rates back into line for any given length of loan. Now you can do this by each length. So it's the same operation. I mean, the beauty of it is that it's simple and clear, and it's been around for a long time, and it's pretty clear to me that it's in the mind of Smith, Ricardo, Marx, Mill, maybe even Took, but somehow it's not formalized. And then it gets lost because neoclassical theory replaces this argument with a subjectivist one. And then all the critics of neoclassical theory will remain trapped in the subjectivist argument, trying to figure out a different subjectivist path rather than focusing on the objective factors.